Hello everyone, I'm Steve Savant, syndicated financial columnist and money killer commentator. On today's show, the 3 most important financial statements. Part 4 in our series on demystifying your financial statements with certified public accountant and MBA, Marcy Maslov. Welcome to segment 4, Marcy.
Thank you.
Well, you know, we're all they're having a little come to Jesus moment here on the show here. We're trying to get our ducks in a row. The 3 most important financial statements. I mean, you may not have the other ones, but these 3 are non-negotiable in your mind. Give me number 1.
Income statement.
Income statement. Why is that so important?
It's also called profit and loss. It is so important because that is your scorecard for the year. That is the financial report that tells you your sales, the costs of delivering your services and your products, and the profit or loss you have left over. That's like the magic number.
Okay, now I don't want to be looking at this in December, just finally looking at this, right?
Yeah, you want to be looking at this all the way through the year.
Okay, so once a month with my accountant that is a business analyst.
That's right.
I need to be sitting down with him or her for at least an hour a month to make sure we're monitoring and making the surveillance and we're on task.
You want to look at where you are versus last month. You want to look at where you were versus last year. You want to see where you are versus your budget so that you can make changes or adjustments. Absolutely.
I've noticed the way, and based on some of the things that I've dealt with in my career, that people who are waiting to the end of the year cannot make small adjustments as you've just suggested. They're usually major course changes because by the time we get to November, we haven't done any alterations, no modifications, no adjustments.
You've done no planning.
So you're very keen, especially for an income statement, the profit and loss, you're very keen on monthly monitoring.
Absolutely.
So if we make the adjustment is an adjustment, not a major course change. It's not a makeover.
Yeah,
okay.
exactly
All right. All right. What's my second one?
Your balance sheet.
Well, why is first of all, balance sheet, when I think of balance sheet, I think, oh my gosh. It's like most people are saying when they think balance sheet, they think that I did my checkbook.
And your balance sheet is not your checkbook.
It's not,
your checkbook. No. Your balance sheet tells you the value of your business. It has the record of all of the assets. It has, your inventory in it. It has your debt, your credit card debt. It has, basically what you own and how you paid for what you own in very simple terms. What you own versus what you owe and how you funded it.
As an accountant with a business analyst background and a CPA and an MBA, which could be very intimidating for a lot of people.
Yeah, I make it fun and safe, though, Steve.
When I go to a balance sheet, I'm trying to think of like, you just said the golden word. I have credit. I look like I have a balance sheet, but I got this. I've been paying it with credit.
Yeah.
So when is the threshold? When does a person like yourself walk into the balance sheet and say, debt ratio to cash flow? When does this start to become an issue with you?
Your financial statements have stories to tell you.
They do.
They absolutely do. So debt to equity ratio is one of the ratios that will tell you the story of how much you funded and whether you funded it by creditors or whether you funded it by investors. You kind of want to know that because if you're going out for a bank loan and your ratio is too high, in other words, you funded with too much debt, the creditors are going to say, you don't have enough bandwidth to pay me, so I'm not going to issue you more credit. On the other hand, if you have a lot of assets, a lot of cash on hand, you're flush, and you do a current ratio, that will tell you, like for every dollar that you owe, how much cash you have to pay it. Those are the stories your financials tell you. They tell you the history of you. And your balance sheet actually tells you the history of you from the day you opened your door and put in that first $100 in your bank account until right now today.
Is my balance sheet correlated to my net worth of my business?
It is.
It is. Okay. So,
it is.
So when I'm thinking at the end of the day, and you just said, I went to the bank and they just said, I'm sorry, you don't have enough, as you call it, bandwidth to pay me back. Now, as investors looking at this the same way?
They can, yes.
So they're going to say, wow, your debt ratio on your balance sheet, I don't know how I'm going to get paid.
And the investors are going to look at it from a slightly different angle. That's one of the things they're going to look at, but they're also going to look at your market size and your potential for growth and you as a person and how you manage things before they're going to make an ultimate decision.
Now, Marcy, again, I hate to keep bringing up Shark Tank, but it's kind of my MBA education right now.
Sure, absolutely.
I noticed that one of the contestants, or the person that was presenting their goods and trying to get an investment, talked about their revenue for about the first 15 minutes. It sounded great. Yeah. And then at the last second, she accidentally said, one of the Shark Tanks, you have any debt on this? And she said yes. So he goes, so you're asking for a multiple of so much, and she goes, it's this number plus your debt, which she did not know.
Right.
I am surprised, and I'm just saying, for the last 10 years, I deal with business entrepreneurs, people who are making decent money. It's that your debt is on top of that. He's not getting your value of your company. You have debt on this.
Yeah. Yeah, exactly right. And so that's one of the things you need to know. If you ever decide you want to sell your business or you want to bring in investors, you need to know the balance sheet numbers so that you can help manage that. And you can help your investors to know really like how they're going to get their money back, how fast they might get their money back, or what percentage of a share they're going to have in your business.
What's number 3?
The 3 is your cash flow statement.
Oh.
Cash flow.
Cash flow. I've heard cash flow is the mantra of all business. Is that true?
It is the hardest statement for us to calculate.
Why is it so hard?
Because it literally, so every penny that you spend, everything that you do will show up on your cash flow one way or another. And it is very difficult to track some of that, and especially if you're using QuickBooks or FreshBooks or something like that. Because if you make a change, if you adjust your books or something, then sometimes that does not work really well with the cash flow statement formula. Cash flow is cash coming in and where it's coming from, your sources, and cash going out and where you spent it. And you can spend it in 2 categories: investing in your business, like buying furniture, buying equipment, buying inventory, whatever, and financing activities, getting a bank loan or getting investors to invest in you. So this is, there's 3 tiers to a cash flow statement.
In the old days, we used to waste our retained earnings at the end of the year because of the accounting and the way the law dealt with things. So I'd come in and say, oh, I have all this money. I need to buy some more things just to keep my tax bill down.
That was because of your budget, though, more than anything. Because
that's all changed.
Yeah, it has absolutely changed.
That's all changed.
Right.
What about 72T? I'm trying to I'm buying things. I know how much the government, or 79, I'm sorry.
Oh, okay.
Or 79. I'm at Section 79. I'm buying all this equipment, all this computer. I'm thinking what's 3-year property, what's not. I'm trying to straight line that under 79. Do I need to be wasting my net cash flow here because I feel obligated to do that?
You should never waste it because you feel obligated. You should be spending your money because you think it's going to be a resource that you can use to grow your business, my opinion, okay? So I would not spend money just to reduce your income or to, lower your profits. That the IRS might have something to say about that. What I would do is look at what's the business purpose. And if you need the equipment because your current equipment is slowing down or breaking down a lot or whatever, that's when I would be investing in business.
Okay, now
assets.
I'm going to ask you a very important question for my audience and actually for Steve Savant's sake. These 3, my income statement, my balance sheet, and cash flow, how do they interact with each other? How do they correlate? Or do they?
They do.
They do. I was suspicious. So
it's what we call a closed loop system. So the net income on your income statement also shows up on your balance sheet, and it also shows up on your cash flow. So your balance sheet, in your equity section, there's a line item for your net income. That's one of the angles of the triangle, if you will. On the cash flow, we start with the net income that you made off of your income statement, and then it's sort of like a reconciliation to get to the cash in bank. So that is how we have net income. So if any one of those 3 numbers, like if you have net income on your income statement and it doesn't match what's showing up on your balance sheet for some strange reason, or doesn't match what's on your cash flow, you have an issue. You have a problem that has to be investigated.
Okay, so
that's how I find fraud, by the way.
Those 3, they're not reconciling with each other. Would you say are you saying basically the percentage of fraud, the possibility of fraud is going to be high?
I can't judge whether it's high or low. That's just my first opening shot to say either there's a mistake or there's a possible fraud.
Okay, I have a question for you. Did you watch the Hollywood blockbuster The Accountant?
No, movie? I didn't. I should have.
You need to watch it. Because a guy stole money out of his account in a very stealthful accounting way. A person with autism that is a highly trained accountant caught him trying to put the money back in so he could sell the business to investors. Okay, so I recommend that.
Okay.
To me, those 3 did not match. And he was able to tie it down very quickly.
Yeah, there's more to it than that, Steve, but that's where I would start,
All right, so these 3 are these are the non-negotiables. If you're going to really become I'm going from adolescent business owner to, what did you call it? Adulting.
Yeah.
Adulting, not adultery, adulting. Okay.
Right.
Well, no, I think that's very important, those 3. income statement, balance sheet, cash flow. Don't forget to watch our next segment on Take Control of Your Business by Knowing Your Numbers. Oh, there you go. Part 5 of our series on demystifying your financial statements. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.